Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. All right, good morning and welcome to the BOGART Effect. I've got Geraldo joining me today, and we're going to be talking about what are we leaving on the table. So to start, Geraldo, thanks for joining.
Yeah, absolutely, James. Great to be here.
You know, this is a topic that can go a lot of different directions. When we talk about leaving on the table, at the end of the day, we're talking about optimization. And then some of it is the intentionality around the decisions that we're making related to our financial lives. And so what I thought would be best to do is start it out where we were talking about everything while we're in that accumulation phase of life. So this is, you know, you graduate college and you start saving, you start earning, all the way up until you get to the point where you decide to retire. And now you're in what I call the deaccumulation phase. You know, and a lot of times when I think about wealth accumulation, you know, some of it really doesn't need to get overworked, but there are some nuances that I think really can add meaningful value if set up correctly very, very early on. One of the ones that comes immediately to mind is like, just start saving as early as you possibly can. And for a lot of our audience, that might be the message to their kids, right? Is you graduate from college, set up the 401k. And when I think about leaving money on the table, nowadays, pretty much every 401k has a match. And if you don't contribute, you don't get the match. So like the easiest, like making sure that we get it is we make sure we set up the 401k and we start to save. So Geraldo, let's get into this accumulation phase a little bit and talk about that before we kind of transition.
Yeah, absolutely, James. You're exactly right. The best time to start planning is really as soon as you can, and being able to start right out of the gate when you're graduating from college. A lot of life changes going on, but this is really where the value add of having an advisor for the whole family can be of value to the folks that we work with, because we're not just working with the families. We're also want to help the children, really intergenerational type work that we do. And part of that is just even the most obvious things, like you mentioned, can be the things that get missed. And if you're missing the match, first thing, make sure you contribute to the 401k, get the benefit paperwork from your company. What are the rules for that 401k plan? What's the actual match that they can get? And then getting that set up so that they have it set up on automatic deduction from their paycheck. They're at least getting the match.
A lot of times I get asked the question of, when I'm setting this up, should I invest before tax or after tax? And that's not an easy one to just very carte blanche blanket say everybody should do before tax or everyone should do after tax. That is very situationally dependent. What I normally ask is, do you believe you're going to make more money? and the answer usually is hopefully, yeah. Because when you're younger and on a relative basis, you're in lower income, it's absolutely best to save in a Roth on an after-tax basis. It means less dollars, same, dollar for dollar goes in. However, all of the growth is completely tax-free. There is an inflection point, though. I usually find it's when an individual moves from being in the 10 and 12% tax brackets into the 22% and 24% tax brackets that we need to start doing a little bit more analysis as what's best for them. But that's a very relatively minute example of how, when we talk about leaving things on the table, it can be meaningful after you have a 40-year career. And I think it's really opportune to use my joke. I know, Geraldo, you've heard my joke, but the financial advisor in us is going to have you save every dollar you make. We're going to have you work until you're 80, you die at 81. Plan's going to work great. But that's not living, right? And so a lot of these conversations here you're going to notice a theme of save, 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 save more, save always. But there are, opportunity costs associated with your capital. And some people make the decision to consume and use, especially early on. And when you're in your 20s, it's hard because everything is chipping away at those dollars. However, when we talk about leaving money on the table, that's it, right? Like it's one of those things where the more you can save as early as you possibly can, the better off you're going to be long term. That's probably the most foundational thing. If I could go back and talk to the younger version of myself, would be save earlier, save more, consume less.
Me too.
But I very seldomly have I met an individual that hasn't been in that case. All right, sorry, I cut you off, but that's the 401ks. I think with employers, I don't want to ignore insurance options, right? Like if you have the ability to use a flex spending account, a lot of people are uninformed about what a flex spending account is, or a health savings account. Not every employer has those. Get educated, ask a financial advisor, make sure that if there's tax advantaged ways of accumulating wealth, we should be considering those. When we start to leave the arena of retirement and employer related stuff, then I start thinking about the optimization of how are we saving for certain goals. And so, retirement is still a big goal, and especially with the way that corporate benefits have shifted over the last, let's just say, 30 years. I mean, the era of a pension is very seldom to come by anymore. And so now we're finding where people need to save more in order to be able to still maintain their retirement goals. So then it's, how can we save outside of retirement accounts? The number one thing that I see, again, when we talk about this theme about leaving things on the table, is people not taking advantage of IRAs and Roth IRAs outside of the 401k. And one of the strategies we love is, especially when we're in the accumulation phase, is what's called a backdoor Roth conversion. The reason we do this is because you might be at an income threshold that's a little too high to do straight Roth contribution. So you put the contribution into a traditional IRA on an after-tax basis, and assuming you do not have an existing IRA, you're able to convert that contribution on an annual basis, completely tax-free. And so now you've got monies that are sitting in a Roth, again, growing completely tax-free for the rest of your lives. And especially, again, I come back to this time value of money. The earlier we can do this, the better off we are, right? And that's a strategy I absolutely love to take advantage of. All right, I'm hogging all the air time, Geraldo. Anything else you want to add to that?
Yeah, no, that's definitely a very powerful strategy. And again, as you go through, a person goes through their career, and over time, they end up making more money, progressing in their career, etc. Once they get to the point of those phase outs for contributing directly to a Roth IRA. So, for example, a single person, the modified adjusted gross income phase out for 2026 starts at $153,000 and goes up to $168,000. So if you're making over $168,000 as a single person, you're going to be phased out. So that's a great opportunity to go ahead and utilize that backdoor strategy. If you're married filing jointly, the phase out goes up between $242,000 to $252,000. So if you're making over $252,000, you lose the opportunity to contribute directly to the Roth. But that's exactly right. Having this backdoor Roth contribution strategy, and you're doing it over time, and so that those funds. So right now, the contribution limit, if you're under age 50, is $7,500 a year. The catch up, for age 50 plus, is $1,100. The limits for 2026, and so utilizing that backdoor Roth strategy to get funds into that Roth IRA, despite however your income is over those phase outs, is very powerful. One, the funds that are growing in that Roth are growing tax free. You have to leave the funds in there for at least 5 years. Wait until you're 59 and a half. And that's all a part of someone's strategic plan. The goal is not to look at that as, all right, we want to access those funds in the near future. It really is a long-term strategy to save and plan for your future. Doing it consistently over time and an overall comprehensive plan is very powerful. That also leads to another strategy of, all right, let's make sure that we're looking at these accounts outside of employer-sponsored
real quick,
plans.
Geraldo, I just wanted to add, you have until April 15th of the following year to do the previous year's contributions. So for example, we have until April 15th of 2026 to still complete the 2025 contribution. So again, it's one of those where we'll help with the dates and the timing. We haven't lost the opportunity for 2025 if that's something we want to do. And I even have, like, for example, because I'm so diligent at doing this, I do it, January 2nd, right? First open day, I make the deposit for that calendar year. So I've already done my 2026 ones because I want to get the money in these accounts so they can be growing completely tax-free. Sorry, I didn't mean to interrupt you.
Yeah. No, absolutely. That's a great point, James. Thank you for bringing that up. That's exactly right. You have up until April 15th, the tax filing deadline to make a contribution for the prior year. And that's great advice too, is, hey, if you're going to do it up front to get that money in there and let it start growing tax-free sooner. Part of that, just looking at maximizing and optimizing someone's plan, not leaving things on the table. There's another strategy. There's the backdoor strategy that for their IRAs, the backdoor Roth contribution strategy. There's also another strategy, which we call the mega backdoor Roth. And again, that is utilizing, if we take a step back and you go into someone's retirement plans, they have a 401k, they have after-tax funds, or they're making after-tax contributions into their 401k. Outside of, you're going to have those these limits for the backdoor Roth because with the IRS rules, so you can only contribute that much.
7,500.
However, 7,500, and with the mega backdoor, you're able to contribute much more, depending on your situation, to a Roth, utilizing this strategy. So basically, you make an after-tax contribution to the 401k. The 401k is basically a pit stop for those after-tax funds. And then you basically do a direct rollover to a Roth IRA, where the funds will start growing, again, tax-free. The rules, leave it in there for 5 years, wait till 59 and a half, and then you can withdraw them completely tax-free. And you can do much more than that limit of 7,500. And so that's where really you can make a substantial addition to that Roth bucket, even while you're making very high income over the income limits for the Roth IRA. It's a very powerful tool as part of somebody's plan.
So if you can't tell, save and save more, save a lot. I think, especially when we're in the accumulation phase, we've talked about the need for planning, but it's really important to understand what your goals are. A couple other things real quickly that I see while we're in accumulation mode, just when we talk about leaving things on the table, one is aligning savings vehicles with the goal and objective. Like, for example, you might say, I'm saving for college education for my kids, and you're just doing it in your checking account or even a brokerage account. But that's tax inefficient to do it. That's where we should consider something like a college savings plan, like a 529 as an example, where the monies are growing completely tax-free, assuming that they get used for education expenses, as an example. I've also seen situations, again, with the theme of leaving things on the table, where as life events happen, you don't update your estate documents. Or your beneficiary designations, right? So I think it's extremely important. You get married, you need to set up a will, you need to change the beneficiaries on your retirement accounts. You have children, same thing. Update your will, update your beneficiary designations. That's another one that I see all the time. And along those lines too, if you've had job transition while you're in this accumulation phase, I'd love to think that everybody stays at the first job that they had post-college. We know that that's not even close to reality. But a lot of times there's legacy 401ks that kind of just get more or less abandoned out of sight, out of mind. I think it's extremely important consolidate, especially from a cost perspective. You can really drive your costs down. Most 401k plans have costs associated with them, and it's not the most fee efficient mechanism for accumulation of wealth. It is while you're working, especially because you need to do it for the match. But once you leave a company, it's not always the best one. So just something to think about along those lines as well. And I also think it's really something that gets forgotten a lot. And unfortunately, this is one that it's forgotten until we can't get past it. But it's utilization of life insurance for mitigating risk factors while you're in this period of life. And the way I say it, why I say it that way is, insurance in general is what I like to describe as a poke in the eye. I mean, it costs you money for something that you ultimately don't want to have happen, right? You don't want homeowners, you don't want your house to burn down, but you need homeowners insurance to prevent that type of risk. Same with auto, right? Like you don't want to have a car accident, right? But you need auto insurance and you'll be able to hedge against that. But it's the same concept with life insurance. And especially when you start having a family and dependency on your income is so imperative and loss of income becomes such a significant risk factor. I think it's extremely important to make sure that you're looking at having life insurance as part of that wealth accumulation phase of life. Personally, I love relatively inexpensive term insurance. Just hedge the risk that you need. I'm not talking about very expensive whole life or universal life policies. Just keep it cheap, keep it term, hedge the risk, especially while you're in this accumulation phase. Now, I think that's the perfect segue to start talking about what we call the deaccumulation, but this is usually post life event of retirement. Maybe it's post selling a business, but this is where we're now transitioning into. We need to take what we've saved and accumulated and turn it into the income and cash flow strategy that we're going to be able to use to live off of, enjoy our lives. And if you haven't heard us harp on the need for a plan, I mean, the plan is the epicenter of the decisions that are being made. And it's not that, when we talk about this, again, the theme of what have we left on the table or not optimized, this is where now when we're retired, presumably that's when we have the most flexibility because we no longer have a guaranteed income source from a job. Right. And so now we can actually navigate taxable income and really dive into tax optimization work. But in order to do that, we really do need we talk about creating the vision for retirement. Everyone's vision for retirement is different. I do typically see this theme of, we call the go-go, the slow-go, the no-go period, where right when the life event happens, retirement, sell business, whatever it is, you're very active. You're usually young and healthy. Now you have time to go do things. So it's a relatively more expensive environment. And then you start to transition to a little slower, where you're not traveling as much. You're not doing all the things. And eventually you get to a point where health starts to prohibit you from actually being able to do a lot of what you were doing beforehand. So, but understanding the cost structure that goes into it, and this is where, as we're building a plan, I think it's extremely important to be honest with yourself about what is it that you are going to be spending. And a lot of times we talk about the needs versus wants, discretionary versus essential, but the reality of it is we need the number, right? And nothing is worse for a financial plan than building a plan with a number, and then the number is significantly different both directions. And I say that because if we overestimate and you spend a lot less, well, then theoretically we're going to have years where we didn't optimize correctly because we were projecting future expenses. On the flip side, right, if we build a base plan with an expense number and we spend, let's just say 50% more, well, now we're in a scenario, and let's just assume we're spending more is still viable, but we're in a scenario where we're going to most likely over optimize based upon future projected expenses. And so, we just need to be honest and intentional. And that's why I think, candidly, a financial plan is the epicenter for every decision that you're going to be making throughout your life, both accumulation and deaccumulation. And it needs to be an organic exercise that you're looking at on a very frequent basis. I would highly recommend at least annually. Personally, I think sometimes if you've got more elements of your plan that are changing, new kids or ailing parent, cost associated with that, whatever it is, we need to be modifying it more frequently than that. But the reality of it is we need to be looking at it constantly. All right. Sorry, I'm talking too much again, but Geraldo, anything you want to add on like kind of the plan build out before we talk about tax optimization?
Yeah, absolutely. Thanks, James. Yeah, definitely in terms of one, just with the plan build out, what are you going to do with your time? How are you going to spend it? What are your goals? What are the things that you want to do? Having those conversations before retirement, thinking those things through, highly important, because those things that you want and desire for yourself and your family, that comes back to the actual expenses that are estimated. So getting and really putting in some work on the numbers. And again, that budget, the numbers that we put together, that's not something that's just a one and done. It's something that has to be constantly monitored, constantly, and again, that's why we meet periodically with our clients. Life changes, what's going on, what were the estimates, are we on track or off track, and then adjusting the plan as needed. But going back to building the plan initially is really taking some time and doing some deep dive on the expenses to make sure that we're getting a realistic number of what they're anticipating for retirement. And again, how does that align for them in terms of, this is what I want to do. This is what would really give me purpose in retirement, what I want to do with my family, my kids, or my hobbies, or volunteering, or even if it's consulting. But how does it all work? Well, it's drilling back to that fundamental number of the expenses. And then from there, we can look at, okay, here's your annual expenses. This is the value that we've come up with after doing the work on it together, and then putting that into the plan. Okay, well, here's the investments that we'd recommend for your portfolio. We're going to look at the tax implications on your cash flow withdrawal strategy to make sure we do it in the most tax efficient way. Stress test the plan. We do this on a regular basis. But again, the building block goes back to, what are the actual expenses that we're looking at realistically? Yeah.
Well, and the one thing I'll tell you too, especially with retirement, I have yet to meet a household that is 100% precise on their expenses that they modeled prior to their retirement. And so I think it's important, obviously, to plan, because we need to plan from a guidepost perspective. But it usually isn't until about 18 months into actually being retired that someone truly knows what their retirement expenses are, like truly knows. So again, I say that just to give yourself a little bit of latitude on this. Now, let's transition over to talk a smidge about the optimization or specifically things that we see that get forgotten about or left on the table with regards to some of the strategy advice. And you're definitely going to notice a tax bias. We already talked a little bit about some of the accumulation strategies with contributions to 401ks and backdoor and mega backdoor Roth conversion strategies. But again, I'm going to go back to this theme of, once you're retired, we can now optimize your taxable income, and we can help with driving tax strategy in a manner to help build more accretive long-term wealth by looking at, where does our taxable income now? What are we projecting it to be? And every household's going to be different. If they've got big retirement accounts, they're probably going to have big required minimum distributions when they turn either age 73 or 75. If they have, let's just say, big after-tax accounts, usually there's tax inefficiency between capital gains, dividends, interest. That all can be driven based upon how the money's invested, or if it's a legacy holding that you've had for the last 40 years because you've been diligently saving, and now all of a sudden we need to unwind, but we have big capital gains implications. Like, those are all things that we need to navigate in a very tax efficient manner. So talk to me a little bit about some of the things we're looking at on the tax side.
Yeah, absolutely, James. One of the things that we communicate to folks that we work with is that one of the things outside of our control is the markets. We can't control the markets, but we definitely can put thought and control into optimizing your plan in the most tax efficient manner. And that's really just comes back from building out your plan. And so specifically, when we look at somebody's plan, we're not just modeling out, okay, hey, what's happening this year in 2026 with your taxes. We're going to be looking at their lifetime in terms of what's their overall tax exposure based on what they're looking to do in retirement. We put that plan together, the cash flow plan. What's their overall tax exposure, and how do we mitigate that tax exposure over their lifetime? So it's really looking at the big picture, so that they're looking at, So, for example, one of those strategies is doing Roth conversions, if it makes sense for that client, over a multi-year strategy. It's usually after they retire, once their income goes down. A lot of our clients do receive, large restricted stock units, or in that first year when they retire, they're getting, the non-qualified portion from their pension. So all those factors taken into consideration, once the income, we believe, reaches a place where we want to max out their marginal tax bracket, whether it's 24%, 22%, just depends on their situation. It could go up depending on their overall income and goals. Once we come up with that strategy, and it's all based on data and math, how do we implement that overall, at the end of the day, and we'll show by the numbers, this is what you're going to have accumulated in a tax-free bucket. And again, a Roth conversion is just converting those large IRA accounts and converting them, paying ordinary income tax on the conversion. You want to do that, again, in the year that you have lower taxable income. So you're paying at a lower rate, and we're trying to max out that lower rate, and then putting that in the Roth IRA account where those funds can go tax-free. And then after 5 years, after 59 and a half, they can be withdrawn tax-free as part of your cash flow. So it's a very important strategy. And I know one of the things that folks get caught up with is just, no one likes to pay a fee up front for doing something. So with Medicare, there's a thing called IRMA, or income-related monthly adjustment, which is if you make over a certain amount in your modified adjusted gross income, Medicare will charge you an additional premium for Medicare Part B and D to say, hey, your taxable income has reached this threshold. We're going to charge you. We're going to, for example, if you made, the modified adjusted gross income goes back 2 years. So if you were age 65 this year, the modified gross income, the IRS looks at 2024. What was your MAGI? So if you made between, for example, or your MAGI was between $342,000 and $410,000 as married filing jointly, you'd get a Part B premium of $324 that IRMA charge per person, and then an additional Part D charge of $60 per person. Now, looking at it, it's like, well, I don't want to pay those premiums. I don't want to give the government any more money, which completely is understandable. However, we really want to look at what's the best way to do this. So utilizing those Roth conversions, intentionally paying some of these IRMA premiums a bit higher for taking that, small hit now, or really the optimization of your plan will far outweigh that. Depending on that person's situations. And again, Roth conversions make sense for their plan.
To summarize that real quick, we're looking at what your future tax implications are going to be and making some decisions years in advance to hopefully reduce and mitigate what those tax implications are going to be based upon where your taxable income is now. And by the way, I would tell you this, every single tax strategy that I've ever seen, it's never one strategy is going to make or break a retirement. It's the value add is in the multiple years worth of execution and discipline on these strategies, and how that grows and compounds. That's where we get the biggest and most valuable add along the way. And we talk about leaving things on the table, but this is one where whether it be avoiding IRMA or even paying the tax now. We've had a lot of clients who have just under-optimized their future plan based upon the fact that they don't want to have the outlays now. And that's fine. Our job is to help educate them and guide them through decisions and make recommendations. But this is an example where in the future, and we have enough empirical evidence now, I've been doing this for about 20 years, this is one where there's no doubt that you're going to see it, where your portfolio will grow over a long period of time, and the tax implications are going to get more, let's just say, detrimental from a tax perspective. And it's something we want to make sure that we're integrating into a long-term strategy. Now, related to this, I would tell you is charitable. And there's really, especially in retirement, there's two different mechanisms for charitable giving. One is we donate highly appreciated stock. Now, I'll say this is not necessarily just retirement. This is in life. I personally believe that if you have highly appreciated positions that you've owned for over a year, you should donate those as opposed to writing checks to nonprofit organizations. So, nonprofits, 501c3s, they don't pay taxes on capital gains. You as an individual do. And let's just say, for example, you own a position, NVIDIA stock. It's done very well lately. And you've had a lot of appreciation in that stock. Well, what I'm suggesting is you donate a share of that stock. And if you still want to own that same number of shares, go use the same cash that you were going to give to that charitable organization and buy that share back. But now you're going to be buying it at a higher cost basis. So all of that appreciation goes to the charity without having to pay capital gains. And that's a strategy I would tell you, regardless of age, we should be considering using donor advised funds or donations of stock in kind, not writing checks. Highly, highly, highly advantageous. And candidly, that's almost one that I'd say, regardless of income as well, if you have highly appreciated positions, you should be donating those shares. The other one is once you've attained the age of 70 and a half, you can start doing what are called qualified charitable distributions. And what this is we're able to donate $108,000 per husband, per wife from a 401k or IRA account, have it go directly to the charity, and it's not counted as a taxable distribution. And once you attain the age of required minimum distributions, RMDs, of 73 or 75, it can actually satisfy part of your RMD as well. So it's a great way of utilizing the account structure, using, especially if you're charitably inclined, to be able to do some donations that create meaningful impact without having to incur more tax, and if anything, can even help in the future with long-term accretive tax strategy. Both of those, just real quickly, are calendar year required. So if we're going to do any type of charitable giving, it has to be done by December 31st, year end, right? So just something to be mindful of as you're building that out. Geraldo, the other one I see a lot is just not not integrating their children into strategies, right? Talk to me a little bit about leaving some things on the table with regards to your kids.
Yeah, absolutely. One of the things that we find is, with families, putting together a solid overall financial plan for them, but in terms of leaving stuff on the table is, part of that, their plan is, making sure, hey, we want to make sure our wealth passes to the next generation. But we also want to make sure that as the children, as they're growing up, as they begin to earn, how are we helping them save and invest? Because again, they're having, what they have in their court, which is time. And so starting at a young age and, even something is, putting in, the max for, a Roth contribution, as long as they have earned income, someone can make a contribution to a Roth up to that earned income amount.
I would say, wealth transfers to your loved ones, right? And this is while you're alive, not waiting until they die. But especially when we see a situation where there's going to be legacy inheritance, it makes a tremendous amount of sense to look at lifetime giving. And we can give, I believe, $19,000 a year per husband, per wife, so $38,000 in total now. And
that's right.
Without even having to do a gift tax form or anything of the sort. And I love the strategy of the Roths. I think that's fantastic, especially for young children that are coming into the workforce or have earned income. By the way, I mean, we have high school kids that have earned income, right? Where mom and dad are setting up a Roth for them, or grandpa and grandma are setting up a Roth for them, and starting to get those savings mindset built in. I think it's fantastic. The other one I see a lot that's left on the table is around estate planning. And I mentioned it while we talk about accumulation phase. I think it's extremely important to make sure that your estate plan is updated based upon life events. So you get married, you have kids, someone passes away, like all of those are kind of very basic things. But with regards to estate planning, the estate planning is not just for the ultra rich, right? Like estate planning really comes down to simplifying the wealth transfer process. Now, there are situations where if you're fortunate enough to have over $30 million that we really need to talk about advanced planning, and I see a lot of opportunities left on the table there. I will admit that's not like most of our client base, nor do I think it's most of America. And so when we talk about estate planning, it's really more around what are the goals of your wealth transfer. And for me, I'll tell you, my number one goal is privacy. Like I don't want the world to know. And I don't want my children to be, or my spouse to be targeted based upon wealth transferring from me to them. Nor do I really want the world to know what I'm doing on the charitable side either, to be honest. But like the point is I view a legacy and estate plan conversation as something that is extremely important around privacy. And so, in most instances, we have to utilize trusts for that. To be able to enhance the privacy of the individual. And outside of that, then it becomes a control conversation. We want to protect your kids from creditors, and we want to protect them from divorce. So, I would tell you in summary, the number one thing I see on the estate side is just not properly utilizing trusts as part of an estate plan. I mentioned it earlier, but updating beneficiaries, we see that all the time where something changes in life. Sometimes it's a divorce. The amount of times I've seen a divorce happen and the ex-spouse is still the primary beneficiary of a retirement plan. Like, and plan beneficiary designations trump everything else, right? So we need to make sure that we're updating those as those happen. And I think lastly, on the estate planning side, it's just communication of strategy, right? Like, what are your intentions? I think that can create a lot of friction upon someone's death. And that has very cascading implications on the dynamics of the family on the other side. So just something to plan or add into a plan. The one thing just in kind of closing, because I know we've gone a little long, is really understanding the tax laws as they change. Because as they change, it absolutely creates new triggers where things, and by the way, this is one where I think it's either have a financial advisor that you trust and work with, or have some type of information source that is credible and accurate, that they can help with some of the key decisions that need to be made. But like, for example, something that went into effect as part of the One Big Beautiful Bill, but in 2026, if you're over the age of 50 and you make over, $145,000, $150,000, your catch-up contributions have to be in a Roth now. And I think a lot of people are not understanding of what that means, but it's forcing savings now in these Roth buckets, increasing, what is paid in tax now. It's not the end of the world, candidly, because I love getting more into the Roth, and that's money that's growing tax-free. But it's something that administratively has to be changed. Otherwise, because some 401k plans, if you don't have your catch-up contribution set to go in on a Roth, they're just not doing it. And now you're not doing your catch-up. And that's something to be aware of. Another law change is if you're between the age of 60 and 63, the catch-up contribution amount increased from $8,000 up to $11,250. It's just for that little 4-year window, right? That you have it available to you.
Yep.
And then as soon as you turn 64 and later, if you're still working, it drops back to the $8,000. So, those are examples where the laws are going to change and they'll continue to change. Being able to be informed on those laws so that we don't leave anything on the table, I think that's a very, very, very important message. Geraldo, thanks so much for the time today. This was a great podcast. Hope everybody got something from it.
Yeah, excited to be here. Thanks, James.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.